Income tax. Introduction. Income tax was first introduced in the year 1860 by Sir James Wilson in order to meet the loss caused on account of military mutiny in 1857. At present, this law is governed by the Act of 1961, which is commonly known as Income Tax Act 1961, which came into force on and from 1st April 1962. Basic concepts of income tax. Tax is the compulsory financial charge levy by the government on income, commodity, services, activities, or transaction. The word tax derived from the Latin word taxo. Taxes are the basic source of revenue for the government, which are utilized for the welfare of the people of the country. The next is basic concepts of income tax. Income Tax Act 1961. The Act contains the major provisions related to income tax in India. Income tax is charged on the income of previous year as per the Finance Act for the relevant assessment year. The Finance Act is passed every year by the Parliament in the form which is known as budget. Finance Act. Every finance minister of Government of India presents the budget to the Parliament. The finance bill is approved by the Parliament and get the clearance from the President of India. It became the Finance Act. The Finance Act is passed every year by the Parliament in the form of popularly known as budget. The Finance Act is a very important for the relevant year. The basic terms of income tax. SSC section 2 in the bracket 7. Assessee means a person by whom any tax or any other sum of money is payable under Income Tax Act, and it includes first every person in respect of whom any proceeding under the Act has taken for the assessment of his income or of the income of any other person in respect of which he is assessable. Secondly, every person who is deemed to be an assessee and an assessee in default under any provisions of this Act. Finance Act. Every finance minister of Government of India presents the budget to the Parliament. The finance bill is approved by the Parliament and get the clearance from the President of India. It became the Finance Act. The Finance Act is passed every year by the Parliament in the form of popularly known as budget. The Finance Act is a very important for the relevant year. Human being. It includes a male, a female, a minor or major, and a lunatic. Second is Hindu undivided family, which is also known as HUF, which means a family which consists of all persons lineally descended from a common ancestor and includes their wives and unmarried daughters. Third is a person. In that there is company. A company includes an Indian and a foreign company, as also any other institution which has been assessed or is assessable as a company. A firm. A partnership firm may be registered or unregistered as per the Partnership Act 1932. An association of persons, which is also known as AOP, when two or more persons join hands for a common purpose with a view to earn an income but do not constitute a partnership, whether incorporated or not. They may be assessed as an association of persons. An association of persons may consist of non-individuals. A local authority, which means any municipal committee or district board. Every artificial juridical person. The term artificial juridical person covers all such persons who cannot be included under any of the first 6 categories. Like for example, idols of gods and goddesses. Example, Balaji Vishwanath. Assessment year, section 2 in the bracket 9. Assessment year means the period of 12 months commencing on the first day of April every year and ending on 31st March of the subsequent year. It is also called tax year, government year, financial year, or fiscal year. The total income of a person and his tax liability is assessed in the assessment year as per the provisions applicable to that year. For example, the financial year or previous year ended on the 31st March 2019. The assessment year would be 1st April 2019 to 31st March 2020. Thus, the assessment year immediately follows the year in which the income is subject to the tax. Previous year, section 3. Previous year means the financial year immediately preceding the assessment year. The income of the previous year is assessed to tax in the assessment year. It is also called earning year, year of account, accounting year of income. It is, however, not necessary that an assessee should maintain books of accounts on the basis of financial year. An assessee may maintain books of account on the basis of any other year. For example, calendar year, Diwali year, but for the purpose of income tax, all assessee are required to follow financial year as the previous year. Agricultural income. Any rent or revenue derived from land which is situated in India and is used for agricultural purpose Income derived from such land by agricultural operations, including processing of the agricultural products raised or received as rent. Any income attributable to a farm house subject to certain conditions is considered to be agricultural income. Any income which is attribute, it can be derived from the land which is situated in India and is used for agricultural purpose. Agricultural purpose and the income which is derived from the agricultural operations. Income derived from marketing process. Any income which is derived from any process ordinarily employed to render the produce to fit for the market. Any income which is generated from the farm building is also a part of agricultural income. Thank you.